Okay, good evening, everybody. I can see quite a few people are entering into our webinar. So thank you so much for your support of the Australian Business Council and Atlas Wealth Group together. This is the second of the webinar series that the ABC is putting on to support members just to navigate this sort of uncertainty amid the regional tensions at the moment. So we've obviously got tonight. We've got another one coming up next Tuesday, the 31st, which is with insurance market. There's been a lot of questions, about home and contents insurance, what happens if your property gets hit by debris or like today, potentially a tornado, but hopefully not. And tonight, of course, we're talking about financial resilience with Atlas Wealth Group. Look, there is a lot of people at the moment who are very nervous about the market, nervous about employment stability. So we're very, very pleased to have Brett Evans here with us tonight as our guest speaker. You may have seen Brett in the media lately. He was actually on ABC Breakfast News last week. He was speaking about the resilience of the UAE and the brilliant expat community that we have here. So he's going to talk tonight about sort of understanding what's changing globally during times of conflict. He's going to talk about cash flow, liquidity, investments, and what if scenarios, and a whole host of other finance topics. So I'll hand over to you, Brett.
Fantastic, Lillian. And I'll just start sharing my screen here so the folks can not look at me, but rather listen, which is usually a better way of going about this. So guys and ladies, can you just let me know whether you can see just in the comments our screen on our presentation on the screen there?
We can see it.
Fantastic. Okay, well, let's get this show on the road. So guys and girls, first of all, I hope you're healthy and safe. This is an unprecedented time. The world's gone through this 1,000 times over, but certainly for all of us, it'll be the first time we're going through it. So I can't help with online education. Dan's the man on that. And I pity the teachers out there trying to herd cats, so to speak, when it comes to teaching the little ones. Remote learning is never easy, but thank God we have the facilities to keep torturing our kids by being able to do that. Obviously, tonight, we're just going to try and allay some fears, provide a bit of context and background in terms of what's going on with respect to what you need to be aware of and what you should be sort of focusing on is probably the key things. Also, I'd like to thank our, Australian Business Council and Australian Business Group Abu Dhabi. These chambers are integral in these times. During the good times, they put on a great show, and whether it's the balls or the golf days or whatever it might be, it's always a fantastic time. But during these sort of times, as a conduit information, I think it's very important. And also thank you to His Excellency Ridwan Jabbat and the embassy team. I think they're doing an amazing job just keeping us informed. Even if there's nothing to say, they're posting, and that's what we like to see. When it comes to any presentation by a licensed firm, it would not be replete without a number of disclaimers. We've got two for you guys tonight. In a very summarized version, all this information we're going to talk about is informational, educational purposes only. Please do not construe this as personal advice. If you do need to get personal advice, please speak to a specialist like Atlas. And then this is our local one, because obviously we're dual regulated both in Australia and inside the DIFC, and it pretty much outlines our licensing and regulated authorities. So who is the Atlas Wealth Group? We're the leading provider of Australian expat financial advice, tax, mortgage and asset management services for Australian expats in over 50 countries. I think last count we're about 65 or 70 countries now. We're regulated by all the acronyms, ASIC, the ATO and the DFSA. We currently manage over $500 million in assets on behalf of clients, and all of our specialists are degree qualified with numerous postgraduate certifications. So any specialist you talk to at Atlas actually has a degree in that profession. It's not, they weren't selling used cars the day before and have now decided to get into the financial advice space. So on the agenda tonight, we're going to talk about, the uncertain landscape, why this matters now, the expat financial health check, the 6 pillars of expat resilience, practical strategies that you can employ, and action plans. It's always nice to actually have something to finish your evening on, whether you're sitting with your dinner in your lap watching this, you'll have some takeaways from that. At the end of those 5 sessions, we will then open it up to Q&A, expecting to talk about for 30 to 40 minutes, and then we'll try and get a 20 or 30-minute Q&A session on the cards there. So let's get the show on the road. So why does it matter now? it's something that for those folks out there who are clients or you've attended our seminars or webinars in the past, you've always talked about, you've heard us talk about key risks that expats face. And unfortunately, I'm not going to give I told you so's, but what we're going through right now is a realization of those risks. Some of those key risks are currency risk, dollar going against you or for you, geopolitical risk, which is what we're going through right now, legislative risk, not so much a problem for expats in the Middle East, but could be down the track with the May budget happening in Canberra in May. And then last of all is the sovereignty risk, which is sort of dovetails into what we're going through with this geopolitical risk right now. So obviously what we're dealing with, we're obviously got lots of noises going over our heads. Our phones are driving us nuts with alerts. Regional instability is the big one. It's the unknown. It sort of reminds me of the early phases of COVID when we're not sure how long this thing's going to go for. We don't have a time frame on that. We're all drafting information from online through social media and the news platforms, and everyone's got their own opinion, and it's right to be very confused. But I think, like we talk about in our internal team meetings, we talk about focusing on today and tomorrow. What happens, this situation is so dynamic right now. It's understandable to be confused, concerned, but bear in mind that the world has gone through this a lot of times, whether it's COVID, Ukraine, GFC, now the Gulf War, what we're going through right now. To me, it's about managing your expectations and doing what's in your control to be able to trade with this. Obviously, the Australian dollar volatility has been going against the dirham and the US dollar over the last 6 to 9 months. So for those folks who are holding Australian dollars, you're doing well. Those folks who intend to move money back to Australia, you're not going to get as good a price as you did 6 to 9 months ago. Then we also have, changing tax rules in Australia. We've got the proposed, modernising tax residency laws that are still floating around. Footnote, keep an eye out for the May budget this year when we'll be running some seminars in both Dubai and Abu Dhabi, and we'll be talking about that. There's a reasonable chance that it may be raised by Mr. Chalmers. Obviously, then they were talking about, this ATO scrutiny of expats, which in general times has been increasing now that data aggregation, the common reporting standard, is well entrenched in their systems. And last of all, ATO not really come out with any special concessions for returning expats due to the unrest. So I'll go into that a bit more details. And then just to overlay the whole thing, it's been not even 12 months since Trump brought out his tariff changes that are changing all the time. There's a real dynamic shift between Australia and China going on. And then obviously, persistent inflation going on in Australia right now, which led to the increase of interest rates earlier this month. So there's a lot to go through. So let's get the show on the road. So as an expat, it's a bit of a double-edged sword. Obviously the advantages, you have no UAE income tax, which is good, means you potentially can save more. The dirham to US dollar peg means you're earning your salary in a currency that is more often than not the most stable currency in the world. High disposable incomes versus back in Australia, especially if you're buying fuel back in Oz. So, commiserations to those on the call who are back in Oz right now filling up with the tanks. Access to global investment platforms. When you come over here, you're suddenly thrown everything. So there's a lot of considerations there. And the one that a lot of expats forget is you're still able to contribute to super while abroad. There's a lot of misnomers out there by a lot of the, I call them the shiny super brigade. They're the guys trying to sell you Isle of Man 10-year bonds and those sort of things, telling you can't transfer money back to super because it means you're a tax resident. It's wrong. They're just trying to scare you into giving them money. So if anyone ever tells you that, ask for that legislation because it doesn't exist. However, the risks, the Australian US dollar exposure when sending money back home, as I said, the Aussie to the US was about 61 cents, this time last year. Now it's at 71 cents. So it has gapped up a lot. Obviously, no employer super guarantee for UA jobs. Those in the DI have seen some government areas receiving dues contributions, but generally speaking, that's not a broader part of the framework. And when you do put money away for savings, it's not compounded returns. It's just an aggregation of your employer allocating a certain amount that they owe you should you choose to leave at a certain point in time. Obviously, cross-border tax obligations becoming harder now that the world's becoming more digitally with the ATO. Limited access to Australian financial products. There's a lot of companies in Australia just don't want to touch expats. And then the other one too, which a lot of people are addressing in this current market and environment, estate planning across 2 legal systems. So tonight, just like folks to run through this and just sort of self-check themselves and mark themselves as we go through this. So we always talk about emergency funds, how it's important to have it. Now people are seeing the reason why. How many months could you sustain yourself if your income stopped tomorrow? That's a good first question to start off with. Do I know my tax residency status? Am I confident it's correct? This question is more directed at those folks who have arrived in the UAE in the last sort of 6, 12, 18 months. They're probably not solidified here enough yet from an ATO perspective and maybe considering going back to Australia. So just keep that in the back of your mind. Am I still contributing to super and should I be there? We always talk about you want to contribute and accrue assets in the country in turn to return to or retire to. It takes away the currency risk. It takes away the geopolitical risk. If something happens in the region that you're living in, you can just pack your bags and go. You're not worried about selling assets locally and relocating. I'm not saying you do that with all your assets, but certainly a big part of it. Estate planning. What happens to my UAE assets and Australian assets if something happens to me? That's one of those sort of very morbid conversations, but it's a very serious one. We have, unfortunately, as part of our job, we deal with that, I wouldn't say on a regular basis, but we do have clients that pass away more often unexpectedly. And those who do have all the paperwork in place really just, in a very difficult time, feel the benefit of having that. Diversification. Am I exposed to a single currency, a single employer, or a single market? This could be a situation where you're earning in dirhams, you're buying property or shares here. You're all exposed to one market and one currency. So diversification in the good times is impeccable. Encouraged, but obviously during bad times, it is impeccable. And it's one of those things I think we always say to clients is you need to make sure you're planning for the good and the bad at the same time. Not every market, not every country, not every company operates on a singular basis when it comes to returns. So you want an aggregated return across the lot because it acts like a shock absorber when we're going through periods like we are right now. And then currency. When I send money home, do I have a strategy or am I guessing? A number of folks will send money back to Australia and leave it sitting in a bank account. Not only is that not a good use of your money, obviously you get no effective compounding from a decent rate of return, but it also too can send signals to the ATO if you don't have an intent for those funds. So if you're sending money back to Australia to pay for a mortgage, to buy shares, to contribute to super, that has an intent. If you've got money just building up slowly in a general, savings account or a just a normal bank account, would an Emirati do that? Because people need to remind themselves when you are claiming to be a non-resident of Australia, you're a resident of the UAE. So you're treated like an Emirati from a tax point of view. So don't leave massive amounts accruing back in Australia if you are repatriating those funds home. So when we talk about the 6 pillars of resilience, this is something that's been developed over time. And certainly when I went back and reviewed it to prepare for this presentation, it's all still ringing true. And this is something you can employ both in the current situation and also future ones. These days, it feels like we're going through something every 5 years. So I'm not saying that 2031, something bad's going to happen as well. But if you plan for it and it happens, then you've got that peace of mind knowing that you can ride it through. So cash and liquidity, that's an important one. You need to be able to put your hand on some money if the situation warrants it. Currency strategy, always have an idea of where your money is and make sure you are diversified. Superannuation, keep retirement on track. When people are in Australia, a large percentage of their salary is being contributed to super by their employer. When they jump on a plane and come overseas to a tax-free location like the Middle East, what actually happens is they, not more often than not, stop contributing. So with that, it comes with a bit of apathy towards super. You get a statement once a year. You sort of don't really think too much about it. But you need to keep contributing because those gaps, if you're not saving the money locally or somewhere else to the same percentages, what it essentially means is your colleagues and family and friends back in Australia are financially better off from a retirement point of view than you are. So make sure you keep contributing. Obviously, tax residency. If you don't know or it's grey, get advice on it. We're seeing a lot of people who take their advice off Instagram and ChatGPT, and it's wrong. So make sure you talk to a reputable company that actually has a lot of experience in this space and knows the grey areas in the black and white and keeps you away from those danger spots. Property and assets, building wealth across borders. It's important to have a diversified outlook when it comes to your investments. I'm not saying invest all the money in the ASX. It's 1.7% of the world's market. But if you have assets and exposure to all the major global markets and all the major global currencies, they all don't rise and fall together. If the US dollar's strength, the euro's weak. If the yen's strong, the US dollar's weak. So it's good to have that nice varnished across the top protection. And last of all, protection, obviously insurance, wills, and estate planning. These are the 6 things that folks need to keep focus on. So when it comes to cash and liquidity, we like to say to clients, 3 to 6 months of living expenses in cash. Normally I say to clients, keep 3 months here in the UAE for immediate access. You can go in an ATM or go to a branch, and then 3 months back in Australia. So what that means is you can virtually not have a job or not be earning an income or not receiving income for up to 6 months. Gives you a chance to get that breathing space to reset and reestablish and go from there. Obviously, family flight costs, it's a variable right now. Towards the start of this conflict, it wasn't too bad, but those prices are getting pretty steep at the moment. So split your money across jurisdictions and currencies. By doing that, you'll find on average, you'll be able to keep up with most experiences because, as I said, if people are panicking, they're going to US dollars. If they're going to US dollars, then it's dirhams. If something happens with oil and the US dollar falls, you've got your Australian dollars. So it's important to have those too. Know your exit number, end of service, lease breaks, school term fees, flights. What does it cost to leave? That's an important one. And then just put that aside. So if you say, well, I've got to give 2 months notice on my rent and this and this and this, work out an average number and then put that aside. It's something that it's like a will. It's something you do hoping never to use it, but it's there just in case. And automate your savings. Standing orders on payday, if you wait until the end of the month, there's rarely anything left. And we see that time and time again with clients who get their money and I say, okay, do you want to set up this strategy where you're doing it on a monthly basis? Oh, yeah, of course. And then they get busy with work and busy with all their sort of daily life machinations, family, everything, holidays. And then they start skipping. And when you start skipping, it's very hard to get back into that pattern again. So automating it where possible is always highly recommended. So when it comes to the currency strategy, obviously living in the in the UAE, while your future may be AUD, creates a risk. And by that I mean Murphy's Law loves to raise its head at the wrong possible time. Best example I can provide is clients in the UK, and there's a little vote called Brexit. They held all their wealth in sterling, getting ready to move back to Australia. It was May the 15th, I think it was, when they had that Brexit vote. No one guessed the outcome. And that's when the pound fell 20% in a day. Both of those client families had to defer returning to Australia for between 12 and 24 months just to wait for the pound to strengthen back up again to make that move worthwhile. So you don't want to be pigeonholing yourself into a scenario of hoping for the right FX rate, the right foreign exchange rate when it comes time to go, because no one knows exactly what that date is. Sometimes you might plan around a certain date. Other times it might be an environment like we are right now where people are displaced. So the important bit is do not keep yourself all in one currency. As an example, the Australian dollars move between 5 to 8% in single quarters. So you need to find that balance between where your money's sitting and where it's working for you. Dollar cost averaging is a great strategy. By gold cost averaging, we mean if you transfer some money to Australia today, you'll get one price point. If you do it in 30 days' time, the next transfer very rarely will be the same. It will be either higher or lower. So then you don't know whether it's a good rate until the past, historically. So by doing it and taking the guesswork out of it and just picking a day on a month and making those transfers back to Australia, you can smooth out the volatility in the currency. When I first moved to the UAE in 2019, the dollar was at 74 cents the US dollar. Then it went down to 56 during COVID. Then it rose back up to 65, then back down to 59. Now it's up at 71. So if you were transferring money at those different price points, and rather than second guessing it, just doing it, with blind faith, knowing that You'll never get the best price, but there's a number of those transfers that you wouldn't have done because you thought it went lower and ends up going higher. You'll certainly be thankful for that. Use a specialist FX provider, OFX, Wise or similar, beats the bank's rates by 1 to 3%. On a $50,000 transfer, it's $500 to $1,500 saved. So there's a lot of them around. Certainly I see them in the chats all the time with people seeking recommendations. So certainly make sure you use a provider. The banks rely on laziness. They want you just to be able to go onto your phone and pick up the phone and do the transfer that way. And yes, it might be quick and efficient, but if you look at the rate, 9 times out of 10, it's an atrocious rate. Most currency providers, they'll put a 0.5% margin on top of the spot rate, whatever that currency is trading at. Banks will charge up to 3 to 5% on top of that rate. So we're talking big numbers. Match your currency to your obligations. Got an Australian mortgage, keep some income in Australian dollars. You got UA rent, keep some dirhams. That's the easy way to work out where you need to keep your money at any particular point of time. Obviously, Australian property and ASX investments create a natural hedge against the dirham. So very rarely does the Australian dollar and the US dollar, e.g. the dirham, go up at the same time. So find that flexibility between the two. So you're not robbing from Peter to pay Paul. Number 3, superannuation. Everyone's got it. It's a necessary evil when you worked in Australia. What do you do with it? So you can still contribute to super while you're overseas. Concessional caps, which is a pre-tax, is up to $30,000 a year. Non-concessional caps, post-tax out of your own pocket, is $120,000 a year. Your earnings is taxed at just 15% inside super, sitting in Australia. So you're not paying Australian marginal tax rates. Unused concessional caps can be carried forward, and this is very useful when you're looking to sell a property. You can bundle up 5 years of previous unused concessional caps and offset that against the capital gains tax if you are looking to sell a property in Australia, and your contributions don't affect tax status. So I just want to reiterate that. So while you're going through what you're going through and work from home and sort of we're not traveling, so there's that time to go through and do a bit of housekeeping, review your fund. Some funds restrict services for overseas members, or they'll charge different fees, or they'll make life difficult. Look at your options. Consider contributions. It's a compounding effect that the little things done now give you big benefits down the track. Check your insurance inside super, life and TPD. It may lapse after a certain period overseas. Meet a lot of people, every month who have insurance they've been paying for the last 5 years when they can never actually claim on it. So definitely check your life and TPD insurance, and obviously consolidate multiple accounts. You're paying multiple fees on these, which is eating away at your balances. Tax residency, and I'll pay a bit more attention to this one tonight because obviously there's a lot of people in different countries at the moment who sort of displaced. So living in the UAE is not automatically enough to be a non-resident for Australian tax. That's the big one I want to put. The ATO applies 4 separate tests, and you must fail all of them in order to be a non-resident. Not pass, you need to fail. So the resides test, where do you ordinarily reside? Do you maintain a home in Australia? So if you have an Ajari in Dubai, and this is where you and your family live, then you fail the resides test, you reside in Australia, you don't reside in Dubai. Domicile test, is your permanent place of abode outside of Australia? This is where's the centre of your universe. If you're working overseas, but the family's living in Australia, going to Australian schools, then the ATO will argue, you know what, you're not exactly a non-resident, you've just gone overseas to work, and your centre of universe, your domicile, is still back in Australia. 183-day test, very simple. Spending more than 183 days in Australia kicks over into being a resident. And the superannuation test you can ignore unless you're an Australian diplomat or a government officer who has the old Commonwealth super scheme. So very rarely does that apply to many people. So let's just focus on obviously the key topics of what's going on right now with this conflict. There are a number of families who've gone back to Australia. There are people sitting in different countries. So if you have your wife and daughters sitting back in Australia and you're living in United Arab Emirates, doesn't mean you're non-resident, doesn't mean they're a non-resident. As long as they're not entering into a lease, the kids aren't going to a local school, those patterns that show you putting down roots, then you can argue the point that you're temporarily displaced because of what's going on. The ATO may come out with an exemption like they did during COVID, bearing in mind they are a slow-moving beast, so I wouldn't be holding my breath for that. But long story short, if you do have family back in Australia or you're working back in Australia and you can't get back in for whatever reason, it doesn't necessarily mean you're a tax resident. When it comes to if you're in Australia working in Australia and your work is in Qatar, Dubai, Riyadh, then you may need to have a chat to one of the team just to qualify that, because obviously the longer you're there, if you're working in Australia, it's assessable income as far as the ATO is concerned. You should better argue it to say that's not, because obviously you've kept your apartment lease and your cars and your dogs and all those things that make Dubai a home for those folks who are stranded out of the country. So bear in mind, don't fall into the nonsense of trying to, and I've seen this time and time again, especially online, people talking about, we're doing remote learning in term 3 of the term here in Dubai for schools. I'm just going to put it in locally into school in Australia until the summer holidays and then see how it blows out. That will create a problem, I guarantee it. But if you're in Australia, if you're watching the recording of this, I doubt you're staying up for it, but if you are in Australia and you are doing remote learning with the kids back on Dubai time, which is tough, I get it, then that is showing that your ties are still to the UAE and your time in Australia is temporary just because of the conflict going on. So we talk about property and assets. This is the big one. So Australian property, it acts as a natural currency hedge. So obviously Dubai property, no one knows the numbers yet. I think it's too early to call what's going to happen in the local property market. But if you have that balancing act between the two, if one's rising, one's falling, you're sort of getting that balancing effect as well too. 9 times out of 10, you're doing that not to try and negate your returns, but just trying to soften the downside and be able to ride out those sort of short-term volatility like we're going on through here right now. Investment properties are available to non-residents via specialist lenders. Capital gains tax obligations apply even as a non-resident, so plan for that. A lot of folks don't realise that, especially when it comes to selling their former main residence. Rental income is taxable in Australia, but make sure you claim the deductions. Interest costs, depreciation allowances, and those things still apply. Obviously, joint tenant ownership for estate protection. The reason we say that, if a husband and wife own the house together and something happens to one or the other, then it automatically defaults by way of survivorship to the other person. You don't have to go through probate and all those sort of complicated things. Investments and diversification, diversify across geographies. Don't put everything into Australian dollars or US dollars. What we're seeing in the markets right now, and I'm happy to entertain questions in the Q&A about the markets, is both opportunity and a reset and a reallocation of investments. So the baby gets thrown out in the bathwater in all sectors, but not all sectors suffer. So there are opportunities out there. Accumulate wealth in the country you intend to return to or retire to. As I said earlier, ASX funds are accessible, but check your non-resident withholding tax rules. Model and apply it correctly, which can create complications in your tax return. Avoid complex structures you don't understand, e.g. the 10-year bonds, the Isle of Man bonds, and all that sort of nonsense that gets sold by the shiny suit brigade. And last of all, match the investment timeline to your plans. Are you staying or returning? And if so, that'll give you an idea of what to do with those funds going forward. So in the last pillar, we talk about protection and estate planning. No one wants to talk about it. It's a very morbid topic, but once you've got it, you leave it there and you hope you never have to do it. So insurance coverage, health, life, TPD, and income protection, check if Superlink insurance is still active. 9 times out of 10, the UA employee cover may not be sufficient for repatriation of remains. So that's a morbid conversation that we've had to have with clients before, but it is a consideration. Wills have been highly discussed, especially over the last 4 weeks here. And the best way to think about it is you want to have a will in the country. Each country you have people or property or assets in. So even if you don't own property in the UAE, you might have children. So guardianship wills, those things are a key consideration. If you own a property in the UAE and a property in Australia, you need to have one will for each. The concept of a global will doesn't exist. And the reason it doesn't exist is because those wills have to be rooted to the courts of that jurisdiction. There is no global court. So you need to get a will that is suitable for the Dubai courts or ADJD courts or DIFC. They will take into account a foreign will in the absence of any other will. But I say to clients, do you want to leave your directions and wishes up to a person you don't know? If it's in writing, they have to follow that. Beneficiary nominations, that's a big one. Review your super fund nominations. Is it binding or non-binding? Current, death benefits from super are taxed differently from non-dependents. And this is one thing we see quite often. So probably the biggest mistakes we see with beneficiary nominations, number one, they might have done non-binding nomination. What that means is essentially they're not bound, the super fund's not bound to follow your wishes if they think someone else is more deserving. So make sure you go with binding and ideally a non-lapsing binding nomination. Number two, review it. We've had cases before where couples have split up. Many years later, we've reviewed one of their supers and the other person, their ex, is still nominated as a beneficiary. So depending on how your relationship is with that person, that could end quite poorly. So review those things. And I think the last thing we always talk about is when it comes to your nominations, you can only nominate a partner, a spouse, or a financial dependent. You cannot nominate kids or parents or someone else outside of that. Sorry, not kids, your brothers and sisters or your parents outside of that. If you do need to nominate them because there's no one else to nominate, then you're best nominating what's called your legal executive and then your will. And that's why it comes back to the importance of having a will form the direction of where those funds are to be paid. Power of attorneys. These things are important both in the UAE and Australia. If you're incapacitated in the UAE, you're driving down Shakeside Road and a Nissan Sunny takes you out, who manages your Australian affairs? So you need to have a will in both countries in order to be able to manage the worst case scenarios. And look, I don't think people will need them in this current environment, but it's always good as a reference check to go through and just make sure you're ticking all these boxes as you go along. Practical strategies. So temporary term versus automatic tax residency. The ATO looks at intent, ties, accommodation, duration. There's no blanket concessions for regional unrest. So you want to make sure if you are stuck in Australia or you are back in Australia temporarily, make sure that you are showing as many ties to the UAE as possible for this hopefully short period of time. Stagger the repatriation of your wealth. Bringing everything back at once can lead to poor foreign exchange rates. Like I gave that example with the couples in the UK through the Brexit vote. If you spread your transfers over multiple financial years and multiple months, you will find that averaging effect. And who knows, people look at the Australian dollar to US right now at 71, think it's expensive. Michelle from the RBA does 2 to 4 more rate rises this year. The US Fed doesn't do any. The dollar could be at 80 cents. So just bear in mind, we don't know what's around the corners. It's always best to act now on today's prices. When you sell non-resident assets before you return. So capital gains tax as a non-resident may be more favourable. So just look at those sort of scenarios. If you're selling shares as a non-res, zero capital gains tax. But if you become a resident, then you start accruing capital gains tax on foreign assets. So just keep an eye on that. And then re-establish your residency deliberately. So, if you are returning to the UAE, keep the lease, maintain your ties abroad, and if planning to return, 183-day rule is just one factor. We saw people go through that in COVID because they physically couldn't return because borders were shut. Don't think we've got that right now. Talking to folks, the flights coming from Sydney and Melbourne are quite full of people coming back. So that may be a rule that might be hard to ask when Emirates is flying on a daily basis. So just keep that in the back of your mind. In terms of your Q2 2026 financial to-do list, confirm your tax residency. If you do have any questions on it, action it. Speak to someone who knows what they're talking about. Calculate your emergency fund number. I doubt you'll need it through this environment, but you don't know what the next one is. It could be a global pandemic or, the world's full of sort of these, I call them irritating events because they do certainly upset the apple cart of having a nice, quiet, seamless life. But plan for the worst and hope for the best. Set up your regular Aussie dollar transfers. If you are going to return to Australia, make sure you keep those funds flowing back on a regular basis. Review your super, update your wills and beneficiaries. That's one that people don't do and they need to. And then if you do have any questions, certainly, book in for a review. That's the most important part. So key takeaways, zero tax advantage is only powerful if you use it deliberately. So make sure you save and invest and protect it. Currency risk is a silent wealth destroyer for expats. We see it time and time again. Have a strategy, build a strategy out over the next 5 years. I'm going to do this, this, and this. Superannuation still works for you overseas, but only if you manage it. Don't do a set and forget. Tax residency mistakes are expensive and hard to undo. Unfortunately, we have folks that come to us and they go, oh, I've done this or I've done this. We can't put the genie back in the bottle. So if there is any doubt or any uncertainty, reach out because that quick 30-minute phone call could certainly change things. 2 worlds, 2 jurisdictions, current beneficiaries. Make sure you're covered on that. I cannot stress that enough. And you don't need to do everything at once. That might look like a laundry list. Go, you know what? I'd rather plan my brunch this weekend. Do one. And then next week, do another one. And then next week, do another one. Just do little bite size and build it out from there. And by doing it that way, I think you'll find things are a lot more manageable and, you're not trying to chew off too much too quickly. So folks, that is me on everything. And I know everyone loves the Q&A session. So I try to get through that quickly. Don't worry if you've sort of missed stuff. There will be a recording sent out to you. We'll also be sending out a copy of the slide deck as well. I'll also be including my colleague, Ben Turner, who heads up our tax division. Some of you might have met him when he's come over here before to do some seminars. He will be, he's just written a great article on our website too, and I'll include a link to that as well about residency and being temporarily displaced and just some of those do's and don'ts that people need to be aware of. So, rightio, Lillian, I think we throw it open to the questions there. So let me just stop sharing the screen here and we start answering some questions. So guys, there's a chat box there. So please jump in there and start asking your questions and we can start going through them. And if there's no questions just yet, I can start with a few Dorothy Dixes. Here we go. So I'm just going to actually do this a little bit differently because I've never done this before. I'm going to allow Matthew to ask his question live and then see how we go. So, right, Matthew, the floor is yours, mate, for asking your question. Oh, I think you're on mute there, Matt. Okay, I'll go to Damien here. Let's go to Damien. So my wife is actually correct there, Lillian. I cannot do 2 things at once. So just give me a second here.
I'm wondering if you might have to unmute them yourself as you're the host.
Okay, let's...
There you go, Damien, you're live.
Damien, go for it, mate.
No,
here we go.
Chat.
Damien, can you hear us?
Oh, that's me. Sorry. It's Peter on Brownie's computer.
Oh, g'day,
That's
Peter.
why.
How are you? Peter from Abu Dhabi. We all know Peter.
First of all, the chat's disabled, so that might, if you can undo that you might get a few questions in as well.
Okay, let me just try and work that out while you're asking your question. I'll see if I can do 2 things at once.
Cool. I just wanted to check, we mentioned about the currency exchanges and going through reputable foreign exchange like Wise. Does that apply as well to net wealth if we're depositing directly into there, or are we better off moving into Australian banks first and then going over?
No, look, it doesn't really matter how the money gets there, whether it's on the back of a boat or through an Australian bank account or direct. It's more about the intent of those funds, the end game of where that's going. So to me, as long as you can show intent and that intent maps to your claim of being a tax resident of UAE and a non-resident of Australia, then that's fine.
But in terms of the exchange rate that we're getting, if we're going straight into net wealth account, which is obviously an ANZ account, rather than going through like the difference in the percentage that you were saying with the fees?
Once it's in Australia, it'd be no different. So it depends on how it leaves here, the mechanism between leaving Australia, leaving the UAE back to Australia, that's the biggest one. So I'm just trying to work out. So I'm not sure. I've never actually had the chat function blocked here. So give me 2 seconds here. If everyone wants to keep asking questions, I'll try and do 2 or 3 things at once there. So I'll take you offline there, Peter. Brownie.
Thanks, Sam.
Okay, let's see if I can.
I think Matthew had a question potentially. It was definitely very insightful, though. I think I need to take Atlas's to-do list and go through it myself this weekend.
I'm not saying it's the most exciting thing to do on weekends, but it is,
Yeah,
like, sometimes we like to call it the necessary evil at times. It's something that
yeah,
I think it's one of those things where I think people, when times are good, it's like tomorrow, next week, next month, I'll get to it, I'll get to it, I'll get to it. But when you have these scenarios of unrest and uncertainty, it can sort of really sort of raise things up to a point where people sort of just start to really reassess things, and not saying reassess
yeah,
being him. And
absolutely.
I think we'd all agree on the call that the UAE has done an amazing job. In actual fact, the longer you hear through different events, whether it's COVID or whether it's this right now, it just shows that they can stand up and do what's right for the region and do what's right for their residents. So I think that, to me, is a
Absolutely.
big part of things. And I think that's something that I think people are going to take away from this and make the place probably more appealing from that point of view. Certainly in the back of everyone's minds, they're going to be looking across the Gulf. But to me, I think how they handled it and how they protected the residents is a big part of what we're seeing right now. And just something for the files. To me, as Atlas, we haven't seen any clients go back to Australia permanently who weren't planning already. We have had some who have gone back because they were going back anyway and they brought it forward. But everyone else who's hanging around and saying, we don't have any problems with what's going on, and we're happy to stay and ride this out. So I think at least we don't have the fuel prices problems to deal with, which is what's happening to folks back in Australia right now. There's some absolutely shocking stories going on there. So
Yeah, it's a tough one, but I think at the end of the day, it's only ourselves that can, make those personal decisions, such as getting our finances in order. I know
yeah,
I've been meaning to put my name on our title deed, that the apartment that I have with my husband, for about a year and a half now, and I just keep procrastinating
yep,
because, like you said, we don't want to think about the morbid what if scenario. But I have seen unfortunate situations where spouses have passed away, and it has just been an absolute nightmare for the poor widow or widower who's grieving at the time to then have to deal with the financial aspect of it. So it's better to have everything in order and not need it than have the worst case scenario happen, and then you've got to deal with that.
yep. Okay, guys, I think the chat function is enabled. So just anyone
Great.
like to put some questions in there? Okay, yep. Peter's given us a yay. So I can do this sometimes, not always, but when it's performing. So guys, start sending your questions through. If we don't get any questions in a second while everyone's pontificating on those questions, I will actually throw out some Dorothy Dixer questions that we have been getting over the last 4 weeks. So while we're just waiting for those questions to come through, probably the obvious question is it a good time to buy, whether it's shares or property or those sort of considerations? And my answer with respect to Australian property would be hold off until May. They've got Albo and his mate Jim. We've got a laundry list of changes about to put through. We don't know what those are yet. There've been leaks out from Treasury in terms of changes to two-year discount and negative gearing and those sort of things. Always better to act with the benefit of hindsight. And to me, with rates rising on the back of that, I think that's going to be a key situation in Australia going ahead for the next 6 to 12 months. Certainly fuel prices, interest rates going up, people's ability to service mortgages will be an issue. The thing with property, and I think this, Lily, you'd probably agree with me on this, property reacts slowly. You don't get, as soon as something happens, it doesn't react straight away. It's always that first seller that starts it in the second. Whether it's UAE, whether it's Australia, it's going to take time for the property market to reflect in the prices. And we don't get those big crashes like we've had in the past. It's sort of people hang on for a month or 2 months and they start to default and they go into default with the bank, and it's a slow moving beast. So in terms of the property market locally, comes down. I mean, I think you can apply the same premise in questioning pre-conflictism right now. How long do you plan to be in the region? If it's anything less than 3 to 5 years, then buying a property here may or may not make sense, because if your whole idea is going to pay the rent off the mortgage, well, the first 2 years we're pretty much just paying interest costs on those mortgage payments unless you're making extra payments. If you're here to 3 to 5, the argument gets stronger. 5 to 10, very different situation. So as to Australia, here it's primarily your principal place of residence, so it's a little bit different decision-making process as far as an investment's concerned. I think people are buying property because they're sick of being evicted, myself included, by the way. I'm on that list. Right, Lillian, we've got some questions coming through now.
Yeah, we do. I'll read them out so that you can answer.
Please.
So we've got Stuart reading, who's asked, would you recommend, someone just asked a question, it moved. Would you recommend rebalancing your portfolio during these times? What general percentage allocations do you recommend?
Great question. And it can be good and bad to do rebalances. I'm not a fan of rebalances. I'm a fan of putting more money in and rebalancing that way. And just to explain to folks out there, if you're holding growth assets like Australian shares, international shares, let's say 60% in your defensive assets, fixed interest and cash and bonds, it's at 40%. That's what's called a balanced portfolio. What can happen is obviously shares will fall more during these sort of times. So that 60% might come down to, say, let's call it 50% if it's a 10% fall. Math doesn't work out, but I'll keep going on. That means either the bonds have gone up or they've held their stakes. So what you can do is sell the bonds that have held up and then rotate into the equities. Essentially, you're buying what you bought previously at a cheaper price. So you're building that exposure back up to 60%. So if you don't have extra cash and you just want to reweight, I do think it's a good idea, Stuart. I think just see how this week goes. We've been telling clients to load the chamber, cock the hammer, but keep the safety on and the finger off the trigger. There's still a lot to play out with respect to this. There's going to be shakeouts. I think the market over the next 6 to 12 months, I do think will go up, but it's going to be a sawtooth. It's going to be quite volatile as we get sort of those shakeout periods. And if you want a bit of a historical example of that, just look back at Ukraine when we did see similar commodity-based supply chain constraints, especially in Europe, with respect to Ukraine when Russia invaded Ukraine. So there are recent historical examples just to get an idea of what you need to be aware of. But certainly, if you're playing the long game, then a rebalance is not a bad idea. So.
Great. Thanks, Brett. Some good metaphors there. Next, we have Ryan. Ryan's asking, if I hold US stocks while being a UAE resident, do these fall under UAE will or do I need a US will?
This is an interesting one. There's 3 probably answers for this. So if they're US stocks on a US domiciled account, then you can have nominated beneficiaries on that account. If it's US stocks on a US account, and it's domiciled in the United States, then you are opening yourselves up to US estate planning tax. And what that means in layman's terms is if you have a joint account, husband and wife, and you hold an Interactive Brokers account and you hold Microsoft, Apple and NVIDIA, and one of the partners passes away and the balance is greater than $60,000, Uncle Sam, the IRS, will take 40% of that balance and then the surviving partner gets 60. So when it comes to the domicile of that account, that's what matters most to answer Ryan's question in terms of where you want to have that will. Certainly, if it's in the United States, you need to probably readjust what's going on there because you can have a will, but you got to lose 40% of your balance. So look at alternatives in terms of buying US holdings, not through the United States. Our preferred way is we buy through Australia, because you can buy Australian listed or US listed holdings through Australian platforms and you benefit from the 15% reduced non-resident tax rate because of the DTA between Australia, and because you're investing through a nominee out of Australia, you're not exposed to the US estate planning tax. So coming back to your question, Ryan, in a simple way, you want to have a will in each country you have, or look at the provider, because you can put nominees on some of those accounts as well too.
Thanks, Brett. And I'm sure that Atlas could probably recommend some good will lawyers if needed in each country.
Definitely.
So a question from Ling Chang. What's the likely CGT upcoming changes in Australia? Seems to be in the news currently. And maybe, Brett, if you can explain what CGT is.
every day it's in the news. Capital gains tax. So when you sell an asset for a profit, the Australian government puts their hand out and says, thank you for your donation. At the moment, for tax residents of Australia, if you hold an asset, shares or property, and you sell that asset and you've held that asset for longer than 12 months, then you get a 50% discount on that capital gains tax bill. So let's say, for example, you bought a property and you made 200, let's call it $200,000 in 2 years, and you sold that property. So your gain is 200,000, but the ATO is not going to tax you on that 200. They're only going to tax you on half of that amount, which is $100,000. So in their Canberra's modelling, they're looking at between reducing that 50% to either down to 35 or 25% discount, as opposed to a 50% discount. So going back to that same example before, if you did make that $200,000 gain, then you'd pay tax on 125,000, not 100,000, if it was 35%. So it's one of those things where we don't know the facts yet. With obviously the Australian Business Council and Australian Business Group Abu Dhabi will be running in-person seminars day after and 2 days after the budget. So we'll definitely be able to tell you what's going on, Ling Chang. But at the moment, it's anyone's guess. We're all reading the same news, reading the same links coming out of Treasury. So yeah, there's a bit of variability going on, and I dare say with what's going on at the moment with Australia, feeling the effects of what's going on in the Middle East, there'll be lots of crossing out on Jim Chalmers' notepad and changing things very quickly, because obviously from their situation, there's going to be a bit of a black hole from a revenue point of view that they're expecting. And if they're planning on doing a 35% instead of 50%, they might do a 25% now. So things are changing very rapidly.
Excellent, thank you. And please do keep an eye on our social media for those upcoming events with Atlas. So Benjamin Catchlove has asked, what do you think are the chances of the new residency rules coming in? And if so, when? And will they stick with the 45 days or likely to extend this?
Eventually it'll come in, as opposed to when. You've got to think about it. The federal government has so many bullets to fire in one budget. We saw Scotty from marketing try to push it through in 2021, but he lost his job, so it didn't get through. Labor did a consultation paper in 2023, September. We participated in that, shot a lot of holes in the proposal, and provided a lot of recommendations from our point of view, what's fair and equitable. It's going to be, coming back to the 45-day question, the Board of Taxation used the wrong reference point when they said they want to align the UK and Australia's tax rules, and they referred to this 45-day rule. In the UK, that only relates to 45 days working in the UK. But the Board of Taxation took it as total time spent in the UK, and that's why they applied it to these Australian recommendations. So we politely advised Treasury of their error when it came to that. We've recommended 90 days. We also said with the factoring, all factors shouldn't be weighted equal. Just the fact you have an Australian passport should not carry the same weight as if your wife was living in Australia, for an example. So we'll see. I mean, there's a lot of changes they had to make to that proposal. I hope they do, because there's a lot of holes in it. As an example, there's probably half the people on this call are beneficiaries of their parents' trust. They probably don't even know about it. And that's one of the key indicators of being a tax resident. So there's a lot of grey in that proposal. But if it does come through, I would say it comes through in the next 12 to 24 months if it does. And then it's got to go through, and it's never retrospective. So then it'll be another 12 months after that before it kicks in. So we'll see what happens. But I do think it'll happen eventually, because it has to happen. Even the ATO themselves are begging for it. There's too much greyness. The expats lifestyle now does not map to 1936 when those rules were originally written.
Thank you, Kurt. We've still got quite a lot of questions, so I'm just going to go through to Alex Stozic now. So he's asking, if his wife and children are back in Australia, they're looking to enrol their children into a private school, which includes boarding, and then after that, his wife will temporarily visit them from the UAE. They have Australian properties that are all rented out at the moment, but his wife and himself, I presume, are working in the UAE and they have a lease and a mortgage here. So his question is, in that situation, would they still be considered non-residents?
We're not allowed to provide personal, obviously recommendations on this from a legal point of view, but a person who his kid's going to boarding school while owning property that's rented out in Australia would not be considered a tax resident as long as their ties to the UAE are still strong. Hijaris and DEWA bills and all those things that map out to what a local resident of any nationality here would have. As long as you can lean on that, employment contracts and work visas and that sort of stuff, health insurance, all maps up to showing that you're a resident here. When your kids are going to a boarding school in Australia, you could send them to any country. So just because they're going to Australia doesn't mean you're an Australian tax resident. You could send your kids to boarding school in the UK or Australia or South Africa or New Zealand or the United States or anywhere in Europe. So the boarding school bit doesn't become a precluding factor. If they become day students and there's a parent there with them, that's when things change a lot.
Great. And I'd watch out, I guess, for the 183-day rule if they're visiting.
Correct. Yeah.
We've got Damien Brown, who I think is actually Peter, but is asking, watching the markets is making it difficult to keep investing, though we know that this is the right time to buy at good rates. With headlines warning of a recession, what does history tell us about timeframes are we looking at for recovery?
So the best way to look at this is, good question. The best way to look at this is during good and bad times, not all companies operate the same. Believe it or not, there are companies that perform well. There are sectors that perform well in recessions. There's companies that perform poorly during booms. We've seen the rotation of money into AI out of the boring stocks, the Procter & Gamble's, the Unilevers. Dishwashing liquid's not sexy, but Nvidia is. So that to me, we do see people they sort of cast a net over the market and say, well, it's going to recession, it's not happening. It just comes back to what you're holding inside of that portfolio. And it's very simple to look at what sectors perform well in a rising rate environment, what sectors perform well in a falling rate environment, and sort of tailor the portfolio in that direction. Because when you do that, you're not going to be making 20s and 30s and 40% returns. But that's not the name of the game. The name of the game is to be putting positive runs on the board in every year, not every second or third year. So, keep investing, making sure that the underlying is solid, making sure that the sectors, the countries, the currency is where you want to be, and to keep powering through it. Best way to describe it is it's like what we're going through tonight with these storms. We know it gets better once the storms are finished. Just the markets take a bit longer, with these sort of environments. There's never been a time in the history of the markets where the market has never recovered from anything. It's always recovered. It's a matter of time.
That's a very good point, and another great metaphor. So William Watson is asking, how could the residency test be impacted by people basing themselves in a third country, so i.e. not Australia or the UAE, which basically means that in a 12-month period, they're not in any one spot for 183 days in the year. So will the Australian government then potentially claim that that person is a tax resident by default?
Okay, no, good question. Thanks, Will, and say good day to Brit for us. As long as you have residency somewhere overseas, that's the big one. So under the current tax rules, the idea of a digital nomad did not exist in 1936. Back in those days, we jumped on a steamer ship and took a boat to become an expat. These days, very different lifestyle. So what that means is if you're not a tax resident of Australia, you need to be tax resident somewhere else. And as long as you've got residency somewhere, you're a tax resident of somewhere, it doesn't mean you have to spend 12 months in that location. We've got clients who are consultants who spend very little time at home, probably 30 to 60 days a year. They're always traveling, but they've got a domicile. They're rooted somewhere. Under the new tax rules, it doesn't become a problem. You don't need to be a tax resident anywhere else as long as you're not tax resident of Australia. So people can work out of Singapore, Thailand, those sort of examples that he provided. That's not a problem. You need to obviously take into consideration those local jurisdictions in terms of how they may tax you, substance tests and those sort of things that, may need to be considered. But certainly not being in the UAE, but claiming from the UAE is not an issue at all.
It's a very good question. This one is a quick one. Julia is asking, what is the easiest country in Europe to open an account?
Depends on the type of account. Is the obvious, in terms of bank accounts, Very rarely will they let you have a non-resident account. Those concepts mainly exist in expat locations like the UAE. Investment accounts, Swiss quote, Saxo, if they're looking at investment accounts, very simple to do it.
And Julia is also asking, a lump sum for resignation taxable in Australia?
Depends on how it's paid. Generally speaking, no. And the reason I say that is if it's a gratuity system coming out of the UAE, it's something you've accrued for the time that you've been outside the country as part of your salary package. So if you're getting paid out for working for 5 years, going back for the last 5 years, the ATO is not entitled to what you're doing year 3 and year 2 and year 1 when you move to the UAE. So as long as it's accrued for the time that you're away, that's the most important part. The exception to that is, say, Emirates crew who have a provident fund. They've got Section 99B to deal with, and I won't confuse the conversation tonight. So if it's a general accrual of a end of service benefit, it's fine. If you're an EK crew member, then reach out to us because there's a whole different kettle of fish to consider.
Great, thank you. So William Watson has just said a wider question for the ABC and Atlas, if they can give a plug to any Australian-owned small businesses in the UAE that people can support to try and help with any cash flow needs. Look, I mean, the ABC definitely has a lot of hospitality venues that, are struggling at the moment with people not wanting to go out. A lot of them are offering discounts. For example, the Spaniel is offering 50% off for all ABC members. We've got Gates Hospitality. If you just keep an eye on our social media, we regularly put Australian businesses that you can help out. Most of them are hospitality based. Brett, do you have any off the top of your head?
Look, the ones you've mentioned, I think what I'll do is I'll put together a list that I can send out tomorrow that I can think of as well too. So I might grab your list and combine it with my list, and when we send it out tomorrow, I'll do it. And any folks out there on the call who have a small business, let us know. info@atlaswealth.com, send it through. We want you guys to be flat chat with business. So send it through because we'd love to be able to support anyone and everyone we can.
Absolutely. And thank you, William, for asking the question. We've just got a couple more questions. Brian Perry is asking, which is better as an investment vehicle in terms of compound interest and peace of mind, real estate or ETFs?
If you're looking at compounding, essentially it's ETFs because you've crystallized a return in terms of dividends coming in and valuation going up, and then it keeps going. In the past, property would have done that, but these days, yields on properties are very small. You're primarily buying property for capital growth, not for income. So we find the J curve in a compounding return tend to be better for ETFs because you've actually got growth and income coming through. Sometimes it might be 5% growth and 3 to 4% income. Gives you a total return of 8%. But when times go flat, you've always got the income coming through that provide that sort of engine room under the portfolio. So in my experience and from what I've seen, ETFs are better at, and certainly peace of mind, 100% ETFs. You can diversify yourself over 40 markets with one share. So very simple to do.
Also depends how much you really want to spend.
It is, exactly. Price point's another thing too. To me, real estate in Dubai is different from real estate in Australia. You didn't sort of clarify that. You can get good yields on property in Dubai. That's 100%. That's a big consideration. But then you just got to deal with the capital side as well too, and your expectations in terms of how long it's going to take for that property to go up. Knowing the UAE market, it might be quicker than people think. So it's a strong beast. It's something that's a bit of an enigma to most people right now. So
it's a circus.
I'm happy to sit on the sidelines and grab my popcorn and watch with intent.
Thanks, Brad. Stuart Reading is asking, do you think it's possible that Australia will introduce tax by citizenship, similar to the US, rather than residency in the near future, so in the next 5 years, for example? And is this being considered at the moment by the government?
No and no. Very conviction when I say that. And the reason I say that is US is pretty much the only country that can get away with it because they have the international firepower to get governments to enforce that sharing of information. That's the only way it works. Australia, we like to think we swing big on the world stage, but from a company point of view and an expat point of view, we do, but from a government point of view, not as big as, say, the United States. Believe it or not, Eritrea and the United States are the only two countries in the world that enforce citizenship-based taxation. And the reason the US introduced it was back in the 1800s to try and tax people who were dodging conscripts during the Civil War. So that's how old it goes back to them. So we think our tax rules are old, but theirs are even older. So don't see Australia being able to force it, or muscle it or get it put through. So no.
It's a good thing. Okay, I think this is our last question. As a yucky, I have to admit I don't know what that is. I rent a rental property in Thailand with no residency, but have permanent residency in Panama. What is the best country to claim my residency? Is it Thailand or Panama? That's coming from Benjamin Catlov. Yachty, sorry.
Yeah, he's got Yachty there. So look, I think the big one is, to me, it's where you're permanently resident. So a rental yacht isn't Thai property. So there's no government ties to that property. So it's movable. It's not permanent in that respect. Whereas talking about permanent residency in Panama, as long as he satisfies the local tax residency laws in Panama, to be able to turn around to the ATO and says, hey, I'm a tax resident of Panama because they say I have to do this, this, and this to be a tax resident, then Panama would be the obvious answer.
Thank you. And we do have actually another question from Ryan Harvey. You mentioned holding US stocks in Australia brokerage account to avoid US estate tax and pay 15% tax. Isn't it better to hold Irish ETFs instead to avoid this tax?
It's the same thing. So what Ryan's referring to there is using UCITS, which are European ETFs, and then holding those European ETFs, which mirror what happens in the United States through an Irish account. It works, but it comes back to the actual account itself. So a lot of folks use interactive brokers, and they'll use Ireland as that hold, and then use the UCITS investments to avoid the US estate planning tax. To us, there's too many variables. We sit at, probably 20% of our client base is US based. So we have a lot of activity and we see a lot of work with the IRS, and they don't subscribe to the same theory when it comes to holding your account through an Irish account with European UCITS. On paper, it should. 100% it should. But we've seen numerous cases where it didn't. If you do have an interactive brokers account, don't take my word, email their estate planning team and they will give you the black and white answer, and usually it's grey. So by holding it through Australia and investing through a nominee company like a Perpetual or a Bank of New York Mellon facility, the IRS doesn't see who owns those shares. Completely foolproof.
Okay, I think that was our last question. If anybody has anything else, please, now's the time to add it in the chat. Otherwise, I guess we'll wrap up. But we've clearly got some very savvy investors out there. And Brett, your expertise has
gets my nerd hat on. I like it. This sort of stuff gets me excited. So, but and I will say good luck for folks tonight in Abu Dhabi and UAE and Dubai with these storms. I'm watching it right now with a bit of lightning outside, so it's starting to pick up. So get your towels ready, get your mops ready, folks, and be safe.
Yeah, absolutely. And that's a great segue into our next webinar on Tuesday, which is by Insurance Market, all about insurance. If your house gets hit by a tornado, hopefully not, or debris, what do you do?
I'm dying for that one myself. Tuesday. That's going to be a good one.
Wonderful.
If my car gets hit by a drone, how does that work? So I sort of know the answer, but I'm looking forward to their response.
Well, thank you so much, Brett, and thank you to Atlas. Thank you also to AusBG, who are our partners in Abu Dhabi. Really, the community support and collaboration that we have in times like this just really does shine through as a silver lining. If you are wanting to get a copy of this webinar, Brett will send out the recording as well as the slides. And as always, if you have any questions for Brett, please just get in touch at Atlas Wealth Group. So thank you so much.
Cheers. Thanks, Lillian, and thanks, folks. And be safe through the storms and look out for the plague of locusts next week.
All right. Thank you, everyone, for your support. Bye.
See you guys.